everyone, and welcome to this week's Financial Flash. Over the next several weeks, thousands of publicly traded companies will begin reporting quarterly earnings. While that may sound like something only Wall Street follows, it's actually one of the most important periods of the investing year. So today I'm going to discuss why earnings season matters. Every 3 months, we get one of the clearest looks at the health of corporate America. It's an opportunity to evaluate whether the companies we own are continuing to execute on the investment thesis that led us to own them in the first place. One of my favorite reminders during earnings season is this: markets don't trade on history, they trade on expectations. The numbers companies report certainly matter, but investors are much more interested in what those results say about the future. That's why earnings season often becomes an important catalyst for the markets. After a strong second quarter, we've seen the market pause over the past several weeks. That's perfectly normal. Markets eventually need fresh information before deciding where to go next, and earnings season provides exactly that. Most investors focus on one headline: did the company beat earnings estimates? Professional investors tend to dig much deeper. One of the strongest earnings reports a company can deliver is what's commonly referred to on Wall Street as a beat and raise. That generally means 3 things. The company beats revenue expectations, it beats earnings expectations, and management raises its guidance for future results. That's about as strong a signal as investors can hope for because it says the business not only performed better than expected, but management believes that momentum is likely to continue. On the other hand, a company can beat on both revenue and earnings, but if management lowers its outlook for the coming quarters, investors often focus much more on that because, once again, markets don't trade on history, they trade on expectations. Another topic that naturally gets a lot of attention during earnings season is valuation. You'll often hear that the market looks expensive. By traditional measures, that's true. The S&P 500 is currently trading at about 20 times forward earnings, compared with a 30-year average of roughly 17 times. But valuation is only half of the equation. The more important question isn't simply, is the market expensive? The more important question is whether today's market pricing is justified by tomorrow's earnings. Higher quality businesses with stronger growth prospects generally deserve higher valuations than slower growing companies. So rather than looking at a PE ratio in isolation, we want to understand whether future earnings growth is strong enough to support today's prices. Current expectations call for nearly 24% earnings growth this year, supported by solid revenue growth and corporate profit margins that remain near historical highs. If companies continue to deliver on these kinds of results, today's pricing may prove to be well justified. If earnings begin to disappoint, however, markets will likely adjust those valuations accordingly. Of course, earnings aren't the only thing investors are watching. Inflation, Federal Reserve policy, economic growth, and geopolitical events will continue to influence markets and can create periods of short-term volatility. Those headlines aren't going away, but several times each year, the market's attention returns to what ultimately drives long-term investment returns, the businesses themselves. That's why earnings season is such an important part of our investment process. It's an opportunity to evaluate whether the companies we own are continuing to strengthen their competitive position, execute on their strategy, and reinforce the long-term reasons we invested in them. It's less about reacting to one quarter and more about confirming or occasionally challenging our long-term convictions. So as earnings reports begin arriving over the next several weeks, don't get caught up in whether a company beats estimates by a penny or misses by a penny. Instead, listen for the bigger story. Is revenue growing? Are profit margins healthy? Is management becoming more optimistic? Are future earnings likely to be stronger than investors expected just a few months ago? Because that's what ultimately determines whether today's valuations are justified. And in the end, that's why earnings season matters. Not because it tells us where companies have been, but because it gives us our best glimpse into where they're going. Because markets don't trade on yesterday's results, they trade on tomorrow's expectations. If you'd ever like to better understand how we evaluate companies, think about valuation or build portfolios around long-term business fundamentals instead of short-term headlines, we'd welcome the opportunity to have that conversation. That's exactly what we do every day. Thank you for joining us for this week's Financial Flash. We'll see you next week.
educational content by the professionals at Styles Financial Services, delivering customized portfolios aligned to your unique wealth goals.